So welcome to this innovation workshop, part of the Genesis conference. So kindly hosted by Mills Reeve and focusing on transformative transactions from private to public, with a really good recent example of a local company that I'm sure you're all aware of, F-star. So just to use as a base to describe the processes of doing a reverse merger on Nasdaq. So just a few housekeeping rules for me here. If you could keep your microphone and camera off whilst the panel is running. There will be opportunities for asking questions, of course, but if you could drop them in the chat box at the bottom, that would be great. And then James Fry, who is chairing the session, will keep an eye on it and pose the question to the panelists. Last few quick points. The meeting is recorded and it's started now. So I'm going to hand over to James now and hope you enjoy the session.
Thank you, Aline, and welcome everyone. So as Aline said, this is a focus session on transformative corporate transactions for UK biotechs. In particular, we'll be looking at the considerations for a private company looking to go public on Nasdaq, and obviously we've got a real life case study here. Many of you will be aware of F-star's listing on Nasdaq. And the panel were all intimately involved in that transaction. So we'll be looking to get under the bonnet of the transaction. So the F-star business listed on Nasdaq last month as part of a business combination with Springbank Pharmaceuticals, which was effected by way of a reverse takeover. So pursuant to the terms of the transaction, Springbank acquired all of the shares in F-star in exchange for the issuance to the former shareholders of F-star of newly issued shares in Springbank. The transaction was approved by the boards of both companies and the shareholders of F-star in July, and following completion of SEC filings and receipt of Springbank shareholder approval, the combined business commenced trading on Nasdaq in November, a few weeks ago. So I'd like to introduce the panel. So we've got both UK and US advisors, and a representative from F-star, John Fitzpatrick, who's the general counsel. So actually, if I let the panel introduce themselves and just say a bit about their backgrounds. So John, first of all.
Thank you, James. Just a bit of background. I'm a corporate commercial lawyer. Been practicing transatlantic for the past few decades, really. And originally from Boston, as you'll probably notice as we get further into this. But I'm also a dual EU-US national and have been practicing in the UK, Europe for a couple decades, really. In addition to my experience in the US, US qualified as well. I was immediately, really prior to this, I was a partner at CMS Cameron McKenna for about 15 years, who I think the UK folks will be familiar with, and my specialty has been and has always been in the tech and biotech space. And when I decided to retire from Cameron McKenna, I wanted to take a biotech public. So that explains where I am today.
Thanks, John. Bill Hicks.
Hi, my name is Bill Hicks. I'm at Mintz Levin in Boston. I'm co-chair of the Securities and Capital Markets practice. I represent mostly companies in the biotech space, both private companies typically that are looking to go public. I take them public and then I represent them when they are public. I also represent investment banks in all of these deals, as well as some crossover funds when they invest in biotech companies.
Thank you, Bill.
That's it.
Thank you, Bill. And Christian?
Hi there. I'm Christian Shearsby. I'm a corporate lawyer at Mills Reeve. I usually split my time between the London and the Cambridge offices, but like so many of you others at the moment, I'm based at home. I primarily focus on the life sciences and biotech sector. but have quite a broad corporate practice otherwise. So working with companies from early stage in their development all the way through their life cycle, and then either an exit via a sale, or as we had in this case, an IPO. So that's a little bit about me.
Thank you, Christian. Well, let's get straight to it. I've got a number of sort of questions I wanted to take the panel through. So the first question I wanted to explore is really whether a listing is the right option for a UK biotech. So really a question for Bill first of all. So for those companies in the audience, Bill, who may be considering going public, what are some of the key factors that they need to consider in making that decision?
You know, I think a lot of EU and UK companies, particularly therapeutics and biotech companies, have been flocking to Nasdaq. There's just a ton of life sciences investors in the US, and they want to trade on Nasdaq. So Nasdaq brings both incredible access to capital, as well as liquidity for the stock once you get there. So I think it's a very popular thing to do. The real question is, are you ready to be public? Do you have the infrastructure in your company, which you can put together relatively quickly if everything else is ready, but is your story ready? When you're a public company, you have to face the music every quarter. And then frankly, real time as data comes in, you're constantly dealing with investors so the question is your story ready to, does it have enough news flow to be a public company? But if it is, then it's a great way to get access to capital and liquidity.
That's great, and a lot of the same considerations, whether it's a US listing or a UK listing there. So if we sort of go on to Christian and maybe sort of talk about some of the pros and cons, and maybe also to focus on some of the early stage steps that companies need to consider to sort of prepare.
Sure, thanks, James. So just looking at some of the early stage steps, I think one of the first things to consider is that you've got buy-in from your board of directors and from your key shareholders, whether they be investor shareholders or significant individuals, because at the end of the day, you will need to get board support and shareholder support to get one of these transactions away, whether that be in the UK or the US. So making sure you've got all your interests aligned and you're all heading in the same direction is very important. I think early stage things you can do, and something I think that people do overlook a little bit is sort of reaching out to professionals early enough in the process, and that's not just lawyers. I think the UK stock exchange in particular, I'm sure Bill will swear the same for Nasdaq. They are really helpful, and they are very keen to get companies listed on their market, and they're full of good advice and knowledge. So having a conversation with them and with your bank or your Nomad early in the process is a good thing to do, and similarly, with your lawyers as well. At that stage where they're running maybe a bit of a beauty parade, they're trying to get people engaged. They'll be willing to come to you and offer you some free advice slightly. So if you've got the opportunity to speak with your professionals, go ahead, do so. Just as a word of caution, I think if I was doing a transaction like this or considering a transaction like this, I'd always consider what my alternatives were. I wouldn't want to get myself in a situation where whatever market it was on and however you were looking to do it was your sort of option of last resort, and you didn't have an alternative in the bag, and that doesn't need to be just hanging on for another listing. It could be a private fundraise. I did one of these a couple of years ago where we actually got all the way past the Pathfinder stage, and then 2 months later we ended up with a trade sale to a US buyer, and that was nothing to do with the business at all. It was obviously still a good, healthy business, hence the interest from the US trade acquirer. It was just that the market conditions and the general economic situation wasn't such that it made an IPO at that stage suitable for them. Other couple of bits and pieces you can be doing is just thinking about your business currently is a private company and then taking it to be a public company, things like your board makeup, your corporate governance, your disclosures, all of these will be heightened once you're on a public market. So if you are thinking of going ahead and pursuing an IPO, you can really start to build some of these bits and pieces in nice and early. Just looking at some of the advantages and the disadvantages, I think Bill's sort of touched on these. It does give you great access to capital, liquidity, and with that you can use your stocks and your shares for many other purposes. James and I have worked on a couple of transactions recently where they've been collaboration and licensing deals, and because there's been a public company involved, they've been able to use that stock as consideration and as incentivization for that transaction. And similarly, you can use it to incentivize your employees. On the flip side, I think you do have to be aware that rather than sort of focusing 100% of your time on the business going forward, there's a good chance that you're going to spend more of your time dealing with short-term requirements to underpin your share price and deal with shareholder inquiries, and you will lose a lot of that privacy and that curtain that you've got as a private company.
Yeah. Great, Christian, thank you. Come to John now. So what were the key drivers for F-star to go public, and what was in the bucket, John, when you were sort of trying to prioritize some of those preparatory steps?
Well, I think listing in the U.S. was a relatively long-term plan for F-star, and it's the reason I joined, and they reached out to me as well, is because it was the intention. I think we had offices in obviously Cambridge, UK, but also in Cambridge, Mass, and those are really the two top jurisdictions, if you will, or places on the planet for biotech. If you're really in the biotech space, you kind of really need to be in the US, or at least that was our perception. And so we would sometimes joke that we were Cambridge squared, taking on our MAB squared technology reference. But I think it matters. If you want to be a global elite player, being in the U.S. matters, and so it sort of, listing in the U.S., is the logical step. I think in terms of preparation, I think it's critical. I always have as a lawyer generally anyway, but I think the more you're prepared, the better you're going to do, and the quicker you're going to do it. There are just a range of things and issues that you need to look at, anything from nuts and bolts to organization. Do you need to restructure to set up a listable co or a reverse merger entity that will be appropriate? Picking up on Christian's point about your investors, you clearly need investors that understand this and can support you in it, and also can support you in the contacts to advisors, and particularly your bankers, and who are your bankers, and picking the right bankers. And I know that both Mills and Mintz have great contacts in that area, which is critical. So even your lawyers are central to all of these things. Interrelate. Your bankers will tell you about your lawyers, and your lawyers will tell you about your bankers. And anything from Nasdaq advisors. Bill gave us great recommendations on the Nasdaq advisor for the transaction. So I think that advisor piece is key. And obviously you want a big firm, but I think it's the people that matter in a lot of ways, as we all know, in terms of advisors, and also with respect to banks. So you want good teams that actually know what they're doing, particularly if you're going into a reverse. There haven't been that many of them. And I think Bill's been on most of the cross-border ones, and Mills has done this one with us. So, if you go that route, you really need a team that understands it. It just expedites things and makes it work better. One other thing is your auditor is key. I mean, who your auditors are, and are they capable of managing this transaction and not getting in the way and creating issues for you? Flexible, good relationship with your auditor, I think, is important. So I guess that would be my my take on it is as a biotech, to summarize, we thought that you need to be in the U.S. in some form or another, but for the reasons that Bill pointed out in terms of liquidity and access to capital and whatnot, it's, Nasdaq makes a heck of a lot of sense. And also on the organization and preparation, I think it's critical. You need the right people, not only on your team, but as your shareholders and as your advisors.
Maybe we'll now talk about the markets that you should be considering as we sort of get through the flow of the further transaction. And maybe if I now turn to Bill, so focusing on Nasdaq, and obviously we've seen a number of UK biotechs going onto Nasdaq. Can you just sort of talk through in terms of your views as to why that is, and what the reasons are sort of driving that?
I think it's the money. I mean, it's always the money. Every deal structure is driven by the money. Companies need access to capital, and so you got to look at what the capital wants. And there's just an overwhelming amount of capital in the U.S. For biotech, and they're used to trading on Nasdaq. So it really, at the end of the day, I mean, Nasdaq's a great exchange. They do a great job, but it's really because that's what the investors want to see. And that's why I would say, my public companies that I work with, almost all of them were able to raise anywhere from $100 million to $500 million this year. And a lot of companies are raising twice just because they can. I mean, there's just an immense amount of capital. So that's why. COVID seems to have jacked it up, not slowed it down.
Okay. Well, becoming on, I think Christian will talk about sort of UK listings in a bit, but I'm interested from John's point of view, why F-star chose Nasdaq rather than say listing on AIM.
I think I already touched on that a bit.
Yep,
I think
you have.
In part, the global, being a global player and being in the U.S. is pretty critical too. So, if I were a infotech software developer, well, maybe I would have approached it a little bit differently. But I think, in the biotech space, the U.S. market is obviously one of the bigger markets just in terms of pharma, but also in terms of deal flow. And then, as Bill points out, the capital, and it just seems to be the proper path.
Yeah. And then turning to AIM, Christian. So, what does AIM have to offer as a venue for UK-based biotechs?
And I think I probably have to start by agreeing with everything that Bill and John have said. That, for a therapeutics business, the natural progression is through the US, and as Bill said, the levels of capital available on Nasdaq are quite incredible. Having said that, they are some of the most sophisticated investors, and I think Bill touched on your story earlier, and I think it's not just about having the right story, it's having a story that sells into the US. And I don't think that just by going into the US you will automatically hit great levels of capital investment. You have to be the right company positioned at the right time. So I think what I'm trying to say is it's horses for courses, and there are good reasons for Nasdaq, but there are also good reasons for AIM as well. And I think probably if you are a slightly smaller business, or your sort of area of operations, your focus is predominantly on the UK, then AIM does have a lot to offer. And I think it's AIM's 25th anniversary this year, and the size of their offerings have grown year on year over that period, and they do a fantastic job. And I think the regulatory regime is set up in such a way that they really do make it easy and facilitate biotechs getting onto a public market. The admission process is quite slick and fairly simple and straightforward. The costs and the timelines of doing such a process are fairly short compared to a number of the other markets. And I think, again, touching on what Bill said earlier, obviously not to the same extent. I don't think we're talking sort of hundreds of millions, but COVID has definitely ratcheted up some of the follow-on and secondary offerings on AIM over the last 6 months. I think RedX announced a fundraise last week of over 25 million. I think Diurnal and Destiny have both done, you know, 10 million pound plus raises in the last month or so as well. So the support is there. The resilience to COVID has been good on AIM as well, and I think it's certainly worth having a look at.
And, you know, I jump in there, having advised in my prior role as an outside counsel on several AIM listings. I mean, it's an excellent option, and don't want to minimize that at all. And it's very effective for European and UK businesses. So in particular, businesses that may have a broader European bent and are not really US focused yet. It's quite a good option, and exactly as you described, Christian. So just that caveat to my prior comments.
Yeah, great. So if we look at this specific transaction, the F-star transaction, because I think we had a discussion earlier. We think it's reasonably unique, a UK private biotech going through the reverse route onto Nasdaq. And I was keen to sort of bring Bill in here to maybe talk more about process. So when we consider those options available to a US private looking to list on Nasdaq, what are the advantages of doing a reverse merger as opposed to maybe taking the more traditional route of going down an IPO? So Bill, do you want to sort of maybe talk about, set the scene on process, and then talk around those advantages?
Yeah, I mean, and there's a number of ways to get public. I think people often think that going public is a binary question. There's actually several paths, and which one makes sense depends on the company. You know, the advantages of a straight IPO, they're very simple. You know, the process is just you putting together you know, a prospectus document and going through the process. When I say simple, I don't mean it's easy. It takes months and months, but you're just marketing your story, and you're working with your banks to figure out what price you can sell an offering at and marketing it. One of the disadvantages, or it's an advantage depending on your situation, in the last few years, it's very difficult to do an IPO if you have not done what's called a crossover round. And a crossover round is basically investors that typically invest in the public markets crossing over and investing in companies that are private. I think that started about 10 years ago because they were getting edged out of, they weren't getting the allocations they wanted in a hot IPO market. That the big mutual funds that would come in when things were hot were getting bigger allocations, and the sector funds that are biotech specific weren't getting the allocation they wanted. So they started investing in the companies before they went public, which got them a seat at the table, and they were able to usually get a bigger allocation as well as a step up. So if and having public investors investing in you when you're private means you're getting validated already by the public market. So when you're actually doing your IPO, you've already successfully sold to the public market. You're just selling more. So that's, you know, that can be a challenge for companies that are not already, don't have crossovers hovering around them already. You know, they don't have the big VCs bringing in the crossovers. So if you don't have that, it can be very, very difficult to do an IPO. A reverse merger with a Nasdaq company like what F-star did has become very popular in the US. And I think it's not been done as much with European companies, but I think it will be as time goes by. It's in some ways more complicated in the sense that you're doing a negotiated, you know, merger with an opposing party at first, and then you go through the shareholder approval process. On the other hand, when you've done it, you take on the cash that the public company already had. You already have their listings, so some of the work's already been done for you, and so that can be very convenient. The disadvantage there is you've got to win. You know, F-star had to beat out many companies, probably hundreds of companies, to get the right to merge with Springbank. You know, the auction. There's an auction process when these Nasdaq companies that get merged with are popular, and when they decide that they need to go through the process, typically because a study has failed, they go out and do an auction. So you have to win an auction. So that, you know, if you roll out of bed and decide you want to do one of these reverse mergers, it's not that easy. You've got to you got to tap into the network. There's a handful of banks that handle all of these, that have the auctions. You got to get on the list so that you find out when these companies are available, and then you've got to go through a process of convincing them to use you, to merge with you instead of other private companies. There's another kind of reverse merger, which is called an APO, which is alternative public offering. You know, that's done by a particular promoter that's taken, I think, 6 companies public, including a German one that I represent. There they reverse merge into a shell that's not trading anywhere. And they combine the existing institutional money with retail money that they have that follows them around. And that's gotten a number of companies public, and they typically trade OTC first. So that's sort of going public, I like to call it. It's a more gradual process to getting listed, but that's out there. And then finally, there's something called a SPAC, which is basically these shell companies, a promoter, which might be a hedge fund, forms a company, raises $100 million for it that is held in trust, and then they go around looking for private companies to merge with. And these healthcare SPACs historically in the U.S. have been very viewed as somewhat predatory, but these life sciences SPACs are actually quite good. With SPACs under the U.S. regulations, if they're traded on Nasdaq, when they pick a private company to merge with, the $100 million or more sometimes that's in the SPAC gets to decide whether it wants to stay or not. And historically, SPACs typically lost most of the money that they had in the kitty when they did the acquisition. So, you market an offering while you're negotiating the merger with the SPAC. These life sciences SPACs actually have more life sciences investors in them rather than people that just invest in SPACs. And so those are actually a very good option if you get approached by one. And there's a lot of them being formed. So that's another thing to look out for, is SPACs.
So Christian, we obviously advise on the UK side of the F-star reverse. So can you tell us a bit more about what makes a reverse merger different from your sort of more traditional IPO?
Yeah, sure. I think Bill has touched on a couple of the key points there. I think the obvious point to make is that the reason for the higher level of complexity and the difficulties is that you're effectively combining two transactions here. You've got your listing, and you have to jump through all the hoops of the SEC regulations to get yourself onto the market and prepare all the documentation. But as Bill said, that the law firms and the banks have done this on many occasions. It's a well-trodden path. But what you're doing on a reverse is you're actually bolting onto that transaction a full M&A deal. And in the case of F-star, it was a cross-border M&A deal, and what the consideration that you're taking for that transaction is the stock in the listed entity. So obviously you need to be able to handle both running both aspects of the transaction in parallel, which itself is a task. And you need to be able to do the diligence and understand why that company is in a position that you're targeting, that it's looking to do a reverse merger. But I think more importantly, and it's the other point that Bill made, is that these processes are highly competitive. I didn't quite realize that there were hundreds of people coming in for auctions like this, but I did know that they were very, very competitive. And I think that's probably one of the reasons why this transaction has been so unique, in that if you are a Nasdaq listed entity, your preferred partner would most usually be another US company, and part of that is familiarity and just commonality there. But also in the US, they have a slightly different process for getting a transaction like this underway. which is via a merger, that option isn't available to a UK company, where effectively what you have to do is a full share sale. And I think one of the most important things that we pointed out at the start of this transaction was that you have to get every single shareholder to sign up to this agreement, whether that be your lead investor or someone who took shares very early in the transaction and you haven't seen for could be for years at a time. And John and the team went through a very detailed process of making sure that the shareholder communications were absolutely spot on, so that we were able to deliver every single shareholder. And that's quite an important point to make, because these transactions are so competitive. They often do have walk-away rights or financial penalties in there, so that if you don't hit your timelines, then you can find yourself, kicked out of the process, and that's understandable, because there will be an alternative there. Sort of taking that one step further beyond the shareholder communications, I think the other really important thing when you're doing this is to make sure that you're able to deliver on the transaction and execute on it. And I think what I mean by that is that a lot of these VC backed biotech businesses have got very complicated shareholder structures, often with multiple rounds of shares, A, B, C shares in there. They could have convertible debt, secured debt, warrants. Usually they'd incentivize people through options. And what you need to do is make sure that you can deliver all of those people as part of this process. And what you'll find, even if you have sort of considered a transaction like this, you'll often find that your venture capital documents at the outset didn't contemplate a transaction of this type. So even if they do provide for an IPO, which might include a Nasdaq IPO or a sale, they probably don't provide for a scenario like this. And therefore you need to really carefully diligence your business and make sure that you can make all the necessary tweaks to enable you to flatten that shareholder structure, remove security, put security back on at a later date. And all of this is absolutely doable. It's just making sure that you get sufficiently out in front of it to make sure that when you're interacting with your counterparty, it looks like a really slick process.
No, thanks, Christian. And maybe I'll come to John, because obviously you were managing the transaction F-star side, John, and all the processes around that. So can you just give your own insights into the process from an F-star perspective?
Yeah, I think I'd piggyback off of a couple of things that Christian said, and also something that Bill said earlier. In terms of the prep, I mean, the competitiveness of these is very relevant. I mean, I think, it is not uncommon to go through several of them in order to get to one where you actually win. And I think there's sort of two elements to that. There's sort of the back end, and then there's the front end of it. And on the back end side of it, it is all the things that Christian was talking about. You don't want to go into one of these in an IPO as well without having properly structured your back end, so that you don't have lagging issues that are going to become difficult in the context of the transaction. In particular, on the reverse merger, as Christian indicated, you don't want to have anything in your structure that's going to make you a bad candidate, given that you do have hundreds of competitors. And so I think on the front end, and I think, I spent a lot of time with James very early, sort of setting up a team to work on this transaction. And we built a relationship and had people ready that knew the business. So once we got into it through secondments and all kinds of different arrangements that we put together to make sure that we would be, properly prepared and good to go once we got deep into one of these transactions. And I think that worked extremely well. So getting ready for this, and you'll probably have a couple tries at it, whether if you go this route is useful. I think on the front end side of it, presenting yourself in the context of the transaction and knowing what the levers are and Bill was excellent on this, by the way, in our transaction, knowing what the levers are on, what is the seller, if you will, who's really the buyer. What are they really looking for? What are the critical issues? We had some early on conversation. I had some early on conversation with Bill, so that when you're putting your proposal documents together, you're not sending the wrong message. And also, I think that familiarity with the people that are involved, the advisors, and those working relationships, so that you get through the deal is quite critical.
Yeah, and obviously we did. Sorry, Bill. Do you want to come in again?
I was just going to say, I wouldn't want people to get discouraged from these because they're in Europe. At the end of the day, the U.S. investors are increasingly looking to Europe because there's an overall feeling that there's great science here, and that it's often looking to Nasdaq. So the investors I represent are constantly looking in Europe. And at the end of the day, their view of the structural issues is we'll figure it out. So if you're the right science, you have a good chance of winning these things, even if it's going to be slightly more complicated because people want to get at the science. And we always figure out a way to do it. So that was one thought. The other thought I was going to say was, if you want to get into this arena, there's a handful of banks that most of the public, I call them fallen angels, these NASDAQ companies that have a lot of cash, and then maybe their trial fails, so they decide to enter into one of these processes. They tend to engage the same banks. So you want to know those banks, or know the people that know those banks, so that when they send out the notices soliciting invitations to bid, that you're on the list. So if you're interested in these, that's something you ought to do.
Yeah. And Bill, you've got relevant contacts into those sorts of entities.
Yes.
Yeah. And I suppose we can't underestimate that we did the whole thing under lockdown or equivalent in both the UK and Boston. Any thoughts around actually those kinds of challenges in terms of doing a really unique and complex transaction with large teams, but effectively in the current environment? Any thoughts around that, or tips from the panel?
I guess when there's really annoying people, you can just shut them off if you're not in the meeting. Other than that, I in some ways, I don't know, it might have helped. Because you kind of, in a cross-border deal, one of the problems is time zones and whatnot. And given that everybody was so habituated to using the Zoom or whatever we use, it may have actually, made us more flexible in some ways. So I think, having said that, though, I think when you get down, and Elliot has pointed this out, I think, in one of his public blogs, he mentioned that, we did this whole deal without ever having a dinner, a drink, or anything with anyone working on the deal, which I have never done. So I think, that you also lose that sort of inner room personal touch that you can solve issues on. So finding ways to get around that, and properly organizing your meetings so that the right people are on and they're focused and they're not turning off the phone, they're actually listening to the meeting is quite important.
Yep. Anything else from Bill or Christian on that?
Yeah, I think it's sort of what John said. It's kind of an interesting dynamic, because on the one hand, you have more personal involvement with everybody because you're in their living room every night, not just on a phone call. I think on the other hand, you're never getting that truly personal touch. So it's kind of a dichotomy. So it's I think it works very well. Obviously, record numbers of IPOs have been done in this year, and they're doing all the roadshows by Zoom as well. So I think we're going to see, after the pandemic fades, that we're still doing this. So I think I think the net effect has been good. That you don't have to travel to have some kind of contact, and I hope we start having personal meetings too, but I think this is proved out as a model, and it's going to continue.
Yeah, and I think we work quite hard in terms of the US and UK advisor teams in terms of budding people up, didn't we, in particular areas, whether that's on the tax incentive side or other areas. So we work to actually matching the teams up. So maybe thinking now around sort of continuing obligations, whether it's as a Nasdaq listed entity or any other public listed entity, and sort of thinking around, you're listed. What's next? How do those compliance requirements drive? So maybe Bill, can you tell us about some of the requirements faced by the board and senior management team of a company listed on Nasdaq, and how that will differ from running a private company?
My Wi-Fi glitched, but I think you asked what's day-to-day life like different when you're on a Nasdaq
in
company
terms of
managing
reporting requirements and the like.
Yeah. So I mean, on the legal side, you're going to be filing annual reports, which are big undertakings. They're called the 10K. You're going to be filing quarterly reports, which are called 10Qs. And then when certain events happen, you have to file something called an 8K within 4 days. If your CFO leaves or something like that. So you're constantly having to go in front of the public and give them an update. For a lot of companies these days, young biotechs are going public really early. You have pivotal trials that are open label trials, i.e. you're not blinded. So you're constantly getting an influx of data, and you're constantly asking yourself, when do I need to tell the public about what I know? Because you don't want to go out and do a press release every day, but when do I have enough? So you come up with strategy managing that, like reporting at conferences and such. But you're just the fact that you are public is just constantly on your mind, and there's inherently a little bit more of a short-term view of the world. So that you're having to report regularly, not talking to VCs who are looking 2 years forward. So it's also, there's added expense for complying with all the legal requirements, complying with all the auditing requirements. So it kind of opens up a whole new can of G&A expense, and then it's just constantly on your mind. You're constantly having to think about what you say when you're meeting with investors, not telling them anything you haven't told everybody else, learning not to fall for their tricks to get you to open up. So it's very fun, it's very dynamic, but it's a lot. Like your life changes when you go public.
Yeah. Christian, anything to add?
Yeah, I think that very much goes for whichever public market you decide to list on. AIM has got a slightly lighter regulatory regime. The corporate governance requirements, for example, they're not there's not sort of written statute. They're guidance, so it's a sort of a comply or disclose regime. But similarly to what Bill was saying, you have to ensure equality of information. So if you say something to one of your key investors or something like that, which could be price sensitive, then that information equally needs to be disclosed publicly, so everyone's playing from a level playing field. Reporting requirements are also similar. So again, slightly lighter. It's annual reporting and then half yearlies for an AIM company, and you're subject to the AIM rules, which again give you a little bit more leeway because they are designed for early stage and growth companies, but you will certainly experience a real uptick in both the sort of level of disclosure requirements, corporate governance, and general day-to-day management of your shareholder base.
Yeah, thank you, Christian. And obviously, John, you're a public company veteran. But how has your role changed then in the last few weeks in terms of that transition from private to public? And how do you see it evolving going forward as well? I'd be interested in that take.
Actually, haven't had much time. Still focused on just getting cleanups and whatnot. But I think having advised several companies pre and post listing, I think, and delistings as well. I mean, I think you need to know. I think back to one particular AIM, complicated, messy AIM delisting I worked on, where, you know, the company just did not want the hassle that was associated with being a listed company, and they just eventually delisted, and not an ideal scenario. You need to go into this knowing what's coming. And fortunately, I think we did that. We started preparing to behave as a listed company a couple of years ago, almost immediately when we started looking at it. So I think you can prepare for this, and I'm a big fan of preparing. And, you know, you can start acting like a public company while you're a private company. And we started sensitizing people, you know, literally years ago about disclosure issues and understanding what it means to be a listed company. And so that's sort of on the back end. But then once you're listed, we just had a very good training session from two Mintz partners yesterday, where they took, you know, we did a Zoom call and you know, they did a very nice presentation on compliance requirements. And, you know, it's a bit of training. It's different. You need to behave differently. I think, you know, there's also the, you know, there's a risk factor too. I mean, I've advised in white collar criminal cases, very serious ones relating to securities fraud, and it's real. I mean, the risks are real. And once you can mess up a lot in a private company and fix it pretty easily. You don't get that forgiveness in a public company. You mess up your financials, you have a problem. And so I think it raises the intensity of everything and the speed with which you have to do it. So, you know, I don't want to make it sound, you know, worse than it is, because Bill, and, you know, you can speak to it. You've advised countless companies. It happens all the time. It happens every day. I guess the difference is maybe it's a bit like the difference between riding your bike in the park and riding it on the street. You know, you need to be a bit more careful. You need to be, you know, need to pay attention. There's a lot more that you need to do.
Yeah. And you need to, you know, to John's point, I mean, you can manage all these risks, but you got to be real with yourself. When you have a problem, if it's a problem that really affects your value, you need to recognize it when it's there and get it out there publicly, rather than just being optimistic. So there's a tendency when you're an entrepreneur to always see through the problem to the solution. When you're public, you have to constantly check yourself and make sure, am I being an optimistic entrepreneur, or am I really okay? So that if you do that, you know, you can manage all these risks, and stocks drop and they fall. And then sometimes they come back up. So, but you just got to always check yourself and not allow yourself to just be someone who always sees the rosy side, because you have a different level of responsibility, but it's very manageable. It's just, you got to take it seriously. You know, one other point to throw in is it adds another level. When you're public, it adds another level to your employee relationships, because when your stock is sky high, everybody's running around, you know, on an adrenaline high. When your stock is low, people are really bummed out because their options aren't worth as much. And often your stock is high and low for no particular reason. So you have another HR challenge, which is, you know, managing that, trying to get people to understand, hey, don't watch your stock price, watch what we're doing. Let's focus on building value. If you build value, the stock price will come. But it's a whole other HR challenge is trying to keep people to have a manageable relationship with their stock price and not let it dominate their day.
Yeah, great. I've almost to the end of my set of questions. If anyone in the audience has any questions, if you can pop them into the chat, and I'll pose them to the panel. I mean, we talked earlier about AIM and Nasdaq and choosing between the two of them. I mean, I suppose there's also the potential of a dual listing in the UK and US. I'm keen to understand actually what the respective benefits of that may be. Christian, do you want to have a go at that question?
Sure. I think there are a number of companies that have started off on AIM and have moved across to Nasdaq, and for a period of time they have maintained a dual listing. But I think in the main, at some point in their life, they have actually gone ahead and cancelled that AIM listing. I think the associated costs with operating in both venues, making sure that you're compliant with both sets of regulations, maintaining advisors in each jurisdiction, and all of the associated costs probably mean that the benefit of having a dual listed is probably outweighed by that sort of cost element. And then also the management time for, if, for example, John was having to split his time between making sure that everything was compliant with both the US and the UK markets, it would put an even greater stretch on the GC, for example. So I think it is possible. I would question the benefit in the long term of maintaining a dual listing. Having said that, I think there is definitely something to be said about using AIM as a stepping stone to Nasdaq if you're not quite at that stage where you're ready to operate in the US or look for funds in the US, and it is a natural progression.
Okay, great. Anything for any of the other panelists, Bill or John, to add on that?
Yeah, I think I would just agree with Christian in large measure, but one thing I would add, on the stepping stone, it's also been done in the reverse context as well. You can reverse into a US listing from a UK listing as well. Complicated, but it can be done. And I think, the stepping stone approach may be a viable one depending on your stage. And I think the big thing is that you evaluate your circumstances at the time, and you don't bite off more than you can chew. And if, you do what is right for you at the time, do you have the right people for whatever approach you're going to take?
Yeah, no, great. I've had a question. So how do the panelists see the appetite for fundraising, presumably in public markets, in the next few years? Bill, do you want to have a go at that question first of all?
Yeah, I think I just did a panel with 4 hedge funds a couple of weeks ago. They're bullish. The markets have been record intensity this year. I've got more deals than I've ever had in a December before. Normally things slow down before the holidays. We're going crazy. I think, there's some speculation as to whether the results of the election would slow down the markets. But I think the overall perception was, if it's Democrats and there's more stimulus, that'll pump the markets. If it's more fiscal control policy, that'll pump the markets. They're kind of glass half full right now. I think in biotech, particularly right now, I think generally the view is at least the next year is going to continue to be scorching hot. So I haven't heard anybody be pessimistic since about early April, and so that's certainly the mindset right now. We'll see, but I don't think you can ever look ahead more than a year. But I think everything is pointing at this year being very busy, and there's so much money on the sidelines waiting to be deployed, and there's a lot of really good science. And I think the money is they're looking at places where they haven't saturated before, like Europe. So I think it's a great environment, both generally, but also for European companies to get united with US money.
Okay, that's great. I was going to ask about the US election, but your view is actually there's no real impact either way.
I don't think so. And that's what people were saying. Some people said as long as you don't have a full slate. In other words, as long as the Republicans win Senate so that you'll have some balance. So there's this runoff in Georgia. I'm curious to see if people get edgy, if that goes Democrat as well. But I suspect it won't. But so far, I haven't heard any trepidation, and people haven't been nervous about that. And people have basically said there's strong suits either way. So no, I think it's full bore ahead.
Great. Anything for Christian or John to add on that point?
No, I think again, the prospects appear positive. One thing I would note is factors like elections do play into approach. I think we may have gone a different approach if the election hadn't, timing wise for us. So, I think that things like that can play into your raise or your approach to a transaction. But I think, I'm hearing similar things to Bill. So
it's all very positive. UK markets, I think, are the same, aren't they, Christian?
Yeah, I think sort of capital deployment in the biotech sector this year is up significantly on last year, and as Bill said, I don't think there's any sign of that slowing at the moment. And I think almost, the COVID pandemic's sort of shining the spotlight on the sector a little bit at the moment as well, and people are really seeing that the opportunities there, the science is there, and people are seeing that if they put the money in, the science will develop faster. So I can't see it slowing either in the next 12 to 18 months.
So really positive news. Good. So I think we're into the last couple of minutes. So I think probably my last question for each of the panelists is actually that one nugget of advice for a UK biotech going public. What would that one bit of advice be? So maybe start with John.
Maybe it's two bits of advice. One is prepare. The more prepared you are, the better you'll do. And the other is choose your advisors well, and choose advisors who actually advise. And, I'd like to thank this team for being real capable advisors, because oftentimes when you get into difficult areas, you just get quoted back, the law or the position. I think having pragmatic advisors on your side in a transaction like this, or any transaction really, but particularly a transaction like this, is critical.
Thank you, John. Thank you. Bill? Bill's paused in Boston. Are you back, Bill?
I'm back.
Did you get the question?
I think it was any last advice. One is, it was something I said before. It's all about the money ultimately. So a lot of the focus is getting to know investors in the U.S. one way or another, through whatever contacts you have, and trying to develop some appetite. And if there's investor appetite, your deal will find you. If there's not, it's difficult. The other is to be patient. All of these things, John and his team were, very patient throughout this deal. You just gotta, you gotta realize that, no pain, no gain. You gotta, when you're trying to do something dynamic, there's always complications. There's always tricks. You got to keep your cool, and you got to keep making cool decisions, and not get frustrated if everything doesn't go easily. So I think it's those two things: money and
fantastic. I don't know if we're going to get. We may get cut off. So I'll thank the panel first. So thank you very much, gentlemen, for that. That was fantastic. But Christian, if I come to you, final thought.
Yeah, sure. Thanks. I think I agree with Bill. The story is really important. I think what we've also demonstrated today is that this is a very tailored process. It's not a one-size-fits-all job. I think Bill's opened everyone's eyes to the various different ways that you can even just do a reverse. So, listen to your advisors, speak with them, and work out what's best for you, and then follow that approach.
Thank you very much indeed. So if I pass back to Aline.
Yeah, thank you very much, and thank you, James, for brilliantly chairing, just on time, spot on. Really enjoyed the discussion. Well, very positive, I think, reflecting on how public markets were looking with our sector. But also, thank you, Bill. I think that's the clearest explanation of what's the difference between an IPO and a reverse merger I've heard. So at least I learned something. Yes, thank you everyone for attending. I thought it was a really good session. Thanks for joining. There are a few more innovation workshops, one today and then on Monday and Tuesday as part of Genesis conference, and of course lots of on-demand content to rewatch if you're interested. On that note, thank you.
Thank you.